S Limited is absorbed by P Limited. The draft balance sheet of S Limited is as under. They have given us the share capital. First, they have given you information about preference shares. They are saying there are 2,000 7% preference shares and the face value is 100. And we have 5,000 equity shares and the face value is rupees 100. And then reserves, debentures, and trade payables. Sundry assets is all that we have on the asset side. They are saying P Limited has agreed, right? If you see the opening line itself, they are saying S Limited is absorbed by P Limited. So S is standing for the selling company and P is standing for the purchasing company. So what have we agreed? They are saying P Limited has agreed to issue 9% preference shares of rupees 100 each in the ratio of 3 shares of P Limited for 4 shares in S Limited. So share exchange ratio is given for the preference shares, 3 shares for 4 shares. So 3 by 4, that's the share exchange ratio. You are paying this to preference shareholders, so it will form part of purchase consideration. Then they are saying to issue to the debenture holders in S Limited 8% mortgage debentures at rupees 96 in lieu of 6% debentures in S Limited, which are to be redeemed at a premium of 20%. You are going to make this payment to the debenture holders. What we pay to debenture holders does not form part of purchase consideration. In 3, they are saying to pay rupees 20 per share in cash and to issue 6 equity shares of rupees 100 each in lieu for every 5 shares. So the share exchange ratio this time is 6 by 5. We will issue the shares at 125. This you are paying to the equity shareholders, so it will form part of the purchase consideration. To assume the liability of trade payables, it has nothing to do with purchase consideration. Question is to determine the purchase consideration. So we have to simply basically find out what we are paying to the preference shareholders and what we are paying to the equity shareholders. We will consider information 3 and information 1. The sum total of that is the purchase consideration. Let's get it. Computation of purchase consideration. We will first consider what you are going to pay to the equity shareholders, of course, of the selling company, right? They are saying we are ready to pay in cash. So cash, yes. Pay rupees 20 per share in cash. Okay, how many shares are there? 5,000 shares are there. So I'll say cash and I write against it 5,000 shares and I'm ready to pay them 20 rupees. So 5,000 into 20, I am ready to pay them 1 lakh rupees in cash. Next, we are ready to pay them in terms of equity shares, right? In terms of equity shares. They have 5,000 shares, and as we have understood, our share exchange ratio is 6 by 5. So that is 6,000 shares will be issued. So 6,000 shares of purchasing company, which is P Limited, and the value of 1 share is 125. So 6,000 into 125, we are giving them equity shares worth 7,50,000. Isn't it? So equity shares worth 7,50,000. I'm just taking an intermittent total, that's it. We are giving equity shareholders something worth 8,50,000. Next, we will like to know how much we are paying to the preference shareholders. What we are paying to the preference shareholders. Go back to the question, preference shareholders, 2,000 preference shares are there. And when it comes to the preference shares, our share exchange ratio is 3/4, and we will issue preference shares at 100 rupees each. Fine. Let us put the figures. Preference shareholders, 2,000 preference shares are there. I multiply that by 3/4, right? 2,000 into 3/4, so 1,500. So 1,500, 9% preference shares of P Limited at the rate rupees 100. So we are giving them preference shares worth 1,50,000. 8,50,000 plus 1,50,000 is turning out to be 10 lakhs. So 10 lakhs is our purchase consideration. Whatever you are paying to the equity shareholders and preference shareholders, that becomes a part of the purchase consideration.